In this video, I'm going to be sharing with you my step-by-step smart money strategy that has made me over $100,000 in the last 90 days. This is also the exact SMC strategy that all of my inner circle members trade, and here are some of the results that they have got from trading this system. I'm going to share with you every single step. There are 5 steps in total. We'll be starting off basic, but as we go on, it will get more and more advanced. So stick around to the end. Even if the beginning is a little bit too basic for you, I promise you by the end of the video, you will have learned some advanced concepts. And at the end of the video, I'll walk you through a case study of a trade that myself and multiple of my inner circle members took together trading this exact strategy. You are going to love this video. Let's dive in. Okay, step number 1 is building my institutional bias. The first thing that I do when I show up to the market in the morning is I map out and understand what is my institutional bias. An institutional bias is the understanding of where the institutions are going to take price, but more importantly, why they're going to take price. And the main way that we read this institutional bias is through market structure, which is a very simple concept. Let's break it down in step number 1. So step number 1, as you probably already know by now, but if you don't know, this is the most important part of trading. You always need to be understanding of what the market structure is telling you. That's the direction of price. In this example right here, what do we see? You notice that price is trading lower, but what we want to identify are the swing points. So these areas right here that I'm marking out right now, you can see that these represent the external swing points of the price leg. And by following these highs and lows, that will enable us to gather an understanding of the direction that market is trading in. For example, you can see that price puts in a high, a low. This is a lower high because it is lower than the previous high. This is a lower low because it's lower than the previous low. This is a lower high, again, lower than the previous high. Lower low, lower high, lower low. So price is continuously putting in lower lows and lower highs, which tells us that price is bearish. We have break of structure, break of structure, and break of structure. So that tells us that price is going to go lower. So if I come into the market in the morning and I see this price delivery, what do you think I'm expecting? I'm expecting some sort of pullback into here and then lower prices after. And so my entire job is to understand how can I get involved in these swing points. When price is trading lower, is bearish, your goal as a trader is to sell here, sell here, sell here, and sell here. So many traders, for some reason, make the mistake of trying to sell down here or sell down here, sell down here. They're already late to the party. So let me show you how you can be waiting and patiently to sell up in here, the premium area of prices. This is where everybody needs to be selling the market. So essentially what we have is after every time price puts in a new lower low, so price goes break of structure like this, break of structure, price is destined to at some point have a pullback. Price will pull back up into somewhere like this, and then again, lower low, lower high, lower low. That is essentially how price gives us our trend. Now, of course, price doesn't just trend in one direction the entire time. What happens is at some point in time, sellers become exhausted, right? The initiation changes. So what happens? Price will give you something like this, lower low, higher high. Okay, something very important has just occurred. We have gone from putting in higher lows, lower highs, lower lows, higher high. This high is now higher than the previous high. That tells us that the institutional bias has changed. Change of character is what we call it. So when we get a change of character, that tells us that price is now getting ready to trade higher. So what do we want to do? We only want to be looking to long the market. We want to buy, but we want to buy at a good area. We don't just buy right now because that's what most traders do. And that's why most traders lose money, because they buy after the break. What the best traders do is they wait for price to come back into a logical area, right? An institutional level, which is the next level, and then trade away from there. And what we do is we wait for price to come back, we wait for an institutional zone, and then we get into the market in this level. And what do? We get out of the market at this high, because all we are doing as traders is trading the trend. We are just trading the structural understanding of price. We only want to trade with the certainties. We only want to trade with the probability. We don't want to be trading anything random. So we trade market structure. We wait for price to change character. Now it's bullish. We only buy when we are bullish. We only sell when we are bearish. Why would we do anything else? We only buy when price has come back, and we only sell also when price has come back. So if you've learned anything so far, it's that price trends, we sell when we're bearish, we buy when we're bullish. Very, very basic stuff. Let's go ahead and get more into the advanced level concepts. Okay, so here we are again. Does it look a little bit different this time? Maybe, but it's actually the same thing. You see, nothing has changed, just the delivery of how it has happened. What do I mean by that? I mean, actually nothing has changed. If we go from this area to this area, we have a high, we have a low. We have a lower low. We have a lower high, right? This high is lower than the previous high. This low is lower than the previous low. Price comes back up. This high is lower than the previous high. And this low is lower than the previous low. So it's still bearish, but it looks very messy. And that's because this is the reality of how price will actually look. Of course, it's not as simple as just up, down, because anyone would get it. You have to be a real professional to be able to read the market when it looks like this and still have the same understanding. So let me show you how you can do that. Essentially, what you want to do is you want to take a high like this one, and then you want to take the corresponding low. That is going to be your trading range. So what you want to do is you want to mark out the low up to the high like this. And anything inside of this level is what we call internal structure. We don't really care that much about internal structure. We care mostly about external structure because that is what we use as our trend. So when price breaks out of this box, like we do down here, that is a break of structure. We have now broke the previous low, right? Break of structure to the downside. So we know that we're bearish. So we had a high, we had a low, we've broken structure. Now we need to understand where is the high that currently controls the market. What you want to do for that is you want to look at your internal structure and you want to find the highest point that price reached before breaking structure. That is going to be your new swing high. So what you do is you map out your new swing high, you mark it out with your highlighter. That's my new swing high. Then price comes in, that's my new swing low. So all that's happened is you've just changed your trading range. Now it's the exact same thing. You have a swing high, you have a swing low. Now you know that you're bearish. You're looking for sells. So what you want to be doing is once we break the low, again, most traders get caught out because they try to, when we break the low, they're selling. But they're all liquidity. Those traders are all going to get stopped out of the market. So what happens is when price comes back up, well, now what a lot of traders do, because they don't understand, is then they start buying. They see this impulsive price action, then they start buying. That's what they want you to do. You start buying, that is when they're getting ready to sell. By understanding this market structure principle, you'd never be selling after the break and you'd never be buying whilst we're bearish, right? It doesn't make any sense. What we wait for is a run of liquidity, institutional level of supply or demand, and then we trade from here and we target this low. Again, we'll get to that later in this episode. You'll understand all of those things. So what happens? We have a low, we have a high. So now what you can do is you can move your trading range. Now my trading range is from the low to the high and then bring it across. And now you wait for it to break out again. And once it breaks out, that is a break of structure. So now let me ask you, where is our new high? If you said this, you are correct. Why? Because this is the furthest point that price pulled back before breaking structure. So now this is our high. So that's the high that we're expecting to be protected, right? These swing structure points are most of the time they hold. 80% of the time, these structure points hold. So you have the edge in your favor. This is why it's the most important part of your trading, understanding where price is going to go to. And so then what happens then? Price will pull back, and it will pull back like this. It doesn't come up in one straight line. And the problem is that most traders, they try to buy these levels, not realizing that price is getting ready to sell. And what happens is why price delivers like this is because it creates liquidity. When everybody sees the price pulling back, retail and a lot of traders are looking to buy the market. And what that creates is a bunch of stop losses. It creates liquidity for the other side of the market. So when smart money or the institutions are getting ready to load up their sells, they have all of this liquidity to take down here because that is what they're targeting, right? It's essentially just a play on human psychology. That's what they do. That's how they manipulate the market. That's how they manipulate price. What we want to do is we understand that as a principle. We want to use that and we want to get in. So we wait for, after price makes a lower low, price comes back up. We want to wait for a run of liquidity, an institutional level of supply, and we want to look at a confirmation in here. Again, all of this you'll understand later. This is just phase one. So that's the reality of market structure. It doesn't just go up and down, but if you understand it, it's basically the same thing. It just goes from high, low, lower high, lower low, lower high, lower low, lower high. And that's your trend. Everything inside of these highs and these lows is what we call internal structure. And what happens is most traders get confused and they think that the internal structure means something more than it actually does. And they try to trade based off of that internal structure. And that's when they get themselves into trouble. Because the most important part about being a profitable trader is being on the right side of the market. If you're going with the trend, there's a much higher chance of you winning than trading against the trend. It's just common sense. Let's get into step number 2. Now, in this step, we're going to be understanding and identifying institutional intention. These are areas of price where institutions, large institutions, have shown you their hand. They've shown you what they are going to do next. So with that, what we want to do is essentially identify that level. Essentially, we're going to use what we learn in the first phase of market structure and combine it with institutional intention. So we have a bearish scenario and we have a bullish scenario. Let's first start with our bearish scenario, right? So the first thing that we do, as we've already established by now, is we understand market structure. So we have a low, we have a high, we have a lower low. So price is bearish. So we are looking for shorts, right? We've already established our bias. We're looking for shorts. Okay, great. Next thing we need to do is identify institutional intention. And here's how you identify institutional intention consistently. What you're looking for is you are looking for a range, liquidation, initiation. Let's break that down step by step. So the first one is the range phase. What does a range represent? Many people don't really understand what is a range. Price is not really trading higher and it's not really trading lower. Why is that? It can be one of two reasons. Number one, there's not much liquidity in the market right now. So price isn't moving much. There's not many active participants. But that only really happens in Asia or in between, important sessions. What about if you're trading in the midst of London, in the midst of New York session, and you get a range? You really think that there's no liquidity? Of course not. What's really occurring here is transactions. Price has met a fair value, an equal area where buyers and sellers are both agreeing on a price, and that's why price is sitting there. But what's happening really is institutional intention is getting ready for a big move. What they do is they understand that when price breaks a low like this, retail gets involved. They want to buy. So there are lots of buyers that come into the market. Well, if the institutional intention is to trade lower, which usually it is if you're bearish, what they will do is they will wait for that money to come into the market and they will meet it with the equal amount of sells. So for example, let's say there's $100 of buy orders. And let's say there are an equal amount of sell orders. There are $100 in sell orders. What will happen is there will just be a transaction and price will stay at the exact same level because there was an equal amount of buy orders than there were sell orders in a dollar value. What does that mean for price? Well, what happens is all of these buys that are sitting inside of this range are being met and settled by the institutional intention. They are being absorbed by institutions. Why are they doing that? Because the institution wants to get involved in the market when there is a lot of people on the other side of the market to take on the orders. Why? Because they have so much money, it's impossible for them to not show their footprint. When they're ready to initiate a big move, they can't hide it. When they put their sell orders in the market, unfortunately, it moves price, right? It's that simple. They can't help disguising their big footprints. So what they do is after a key point has been met and they are waiting and know psychologically through repetition and consistency, because human behavior is predictable and traders are predictable, they understand that after a low gets broken, buyers come into the market. Great. So all of these buyers that are sitting in here that expect price to go higher, again, the institution is collecting their orders. for every $1 that someone buys, they set an order for $1 in a sell. And what they're doing is they're loading up their sell positions in that one area at one price, because that's the price they want to get into. So they match the other side of the order book. All the sellers that come into the market, they just match and absorb all of that liquidity. And what this does is this allows them to stack positions in their desired direction at an equal price. Because if they wanted to put all of their orders through at one point in time, guess what would happen? There wouldn't be enough people on the other side of the market to take their orders, so price would just aggressively sell off. But they don't want to do that, because if they were to do that, then price would give you something like this, and then what would happen? They would have some orders that got triggered here, some triggered here, some triggered here, some triggered here. Their average order value would be a lot lower than they wanted. They wanted to get their average order value in. Let's say their target was, 1.09233. That was their average order value for their target. But because they just initiated all their position, they got some at 109 here. Their average is going to be way lower than they wanted. So they wait for moments where they know there's a lot of people on the other side, and they absorb their orders, because then they're just selling at the same price over and over and over and over again. And what does this do for them? This allows them to get how many orders they want at the price they want. That's why you see a range occur. That is what is actually happening when a range occurs. And then when they're ready, oftentimes they'll give one more phase, which is the inducement phase. What they will do is just before they're ready to sell, they will allow price to trade higher. They'll stop selling and then allow the buyers to take over. Or sometimes they even use the buys themselves to induce price. Because what that does is when you see a range and then you see an aggressive bullish move, typically what you think and what everyone's thinking in the market is, okay, buyers have come out on top. Market is going to trade higher. Now let's buy. So even more liquidity floods the market, and that's exactly what they want, because then when they're getting ready to put the rest of their orders in, they're able to use that additional liquidity to get, again, a better fill. But because they have so much money, yes, it's obvious that price does end up trading lower. And then another thing that happens as well is when price gets below a certain level, they can stop selling, because they understand that the rest of the herd mentality, the rest of the sheep, the rest of the traders in the market, they'll chase the market. So then everyone else starts selling and price continues, and they don't have to sell anymore because everybody else is selling. That's why price is going lower. So they allow the rest of the market, the herd, to get in after they've already done what they wanted to do, which is exactly what they do in every market. But then what happens? After we get something like this, there's a cool-off phase where now all of the sellers are exhausted and the buyers step back into the market. People see that price is, undervalued. They want to buy price back up. They think it's going to trade higher. A number of reasons. And so buyers enter the market, but all the sellers are exhausted. There's no more sellers to take the other side. So price pretty effortlessly makes its way back up to here. However, this institution has protected this level, right? Think about it. This is where it got into the market. So if price was to trade higher than this level, their position would be running in a loss, and they will not want to be running at a loss. So they will protect this if it makes sense for them to do so with extra orders. So when price gets into here like this, let's say, for example, well, they will just execute more liquidity because, again, these institutions, we're talking large level hedge funds, investment funds, small corporate banks, they have pretty much, a lot of cash, let's just say that. So they can deploy that cash and move the market, no problem, no questions asked. They don't even need to use a stop loss because they can just control price. If price goes too high, they'll just initiate more orders and then close their old orders and then try and balance out their old orders, right? That's how they go. It's rigged. It's just rigged. But we can play the game. We can play the rig. That's what we do. So enough of my rants. Essentially what we can see is price can come back into what we know as an order block, right? You've probably heard the term before, order block. What an order block is an area of price that is blocked with orders. It's super simple. It's an area of institutional intention. This is the area where they have initiated their intention from and protected their intention. So when price eventually gets into here, one thing can happen. Number one is they will have more orders resting at that level. Maybe they weren't able to get their full amount of sells executed. So they leave some in these levels, hoping that when price comes back, it will trigger them. And then what do they get? A better average order. Or if they want to protect the level because price is coming up aggressively or something like that, then they can initiate more liquidity, more sells until price eventually comes down like this. So what our entire strategy is predicated on is waiting for number one, as we've just established, step number one, our directional intention, our directional bias. What's the bias of price? What is our structure? Once we know that price is bearish, like we do, right? Now we have a swing high and we have a swing low, we're looking to sell. Step number one. Step number two, identify institutional intention. If there's no institutional intention, we're not interested. When there's institutional intention, we're interested. We wait patiently for price to come back whilst all the rest of the sellers get murdered and all of the buyers get on the wrong side of the market. We wait for everybody else to make their mistakes. And then when price comes into this level, price will almost always continue trading lower. That's why market structure has an 80% success rate. So what we do is we want to wait for this institutional area of intention to get mitigated, wait for a lower time frame confirmation. We don't just execute this area. We wait for confirmation to tell us that, okay, yes, they are protecting it. It's very evident. We can see right now that sellers are taking over the market in this second. Therefore, we're going to execute our position because they are protecting it. And that is our strategy. Again, market structure, institutional intention. We wait for price to come back into this institutional intention. We wait for our entry model, and then we get out at the structural low because all we're doing is waiting for price to print new structure. That's it. So let's quickly recap that with a bullish example so it makes sense. Very, very simple terms. We have a high, we have a low, we have a higher high. Price is bullish. We have a range, an inducement, aggressive move. There we know institutional intention has stepped into the market. We're already bullish. We have a new swing low. Price starts coming back. We have a new swing high. We wait for price to come into back inside of our range, inside of our institutional intentional area. Then we wait for lower time frame confirmation, because when price comes down like this, as price trades lower like this, the lower time frame looks bearish. And at some point, when price comes in here, when buyers take back control of the market, you'll get a shift from bearish price action to bullish price action. That is our confirmation. Then we look at getting involved in this lower time frame, and because we trade the lower time frame, we have a smaller stop loss, therefore a larger take profit. We put our stops in, we get the rest of our position out, and we look at taking out the swing high. That is pretty much the setup. Phase 1, market structure. Phase 2, institutional intention. Phase 3 is how do we get into the market? That is our entry model. Let's get it. Now, for step 3, we're looking at institutional manipulation, which is essentially when just before price reaches our target for where price is gonna sell from, it will create another inducement just before it for the purposes, again, of curating liquidity. So what does that look like? Well, first and foremost, let's tie everything together so we can come back around full circle and build the full picture of our understanding. It's useless just giving you individual concepts. What's important and what the key is tying everything together into a workable model. So step 1, as we know, was building our institutional bias. And so that's what we need to do first. We need to identify our primary structure ranges, which is very clearly like this. You can see that we're bearish. Therefore, our institutional intention is bearish, lower prices. Okay, step number 2 was identify our institutional point of interest, right? Essentially what we're looking for is, number 1, here's our swing high, here's our swing low. Now, just before price aggressively sold off, what did we have? We had range, manipulation, initiation. So this area here, right, this final kind of buy to sell range, that's going to be our institutional intention, right? Our order block. So that is step number 2. Now we have a working understanding of where price is going. We have a working understanding of where price is going to go to before it goes. Now we need to understand institutional manipulation, because what happens to a lot of traders is they may understand that price is bearish, amazing. And then unfortunately what will happen is there'll be some kind of internal structure or internal liquidity that gets built. And then essentially what they'll do is they'll try and short early, right? There are lots of traders looking at this and they see this kind of, resistance forming in the form of, equal highs or resistance or whatever it may be. There'll be some sort of internal liquidity that gets formed. That's for my highest probability setups. So some sort of internal liquidity. And then what will happen is, obviously, number one, there are a bunch of stop losses that go above these highs. And then what happens is essentially price manipulates above that liquidity pool like this. Now, why is this move so important? This move is not insignificant by any means, because what happens, especially when you combine time with this concept, which is what we'll get into when I break down the trade, when you understand this aggressive move here into a liquidity pool, what you have to understand, especially when it's at a key time, is the amount of people that see this as a break of structure or a break of resistance or a breakout, and they're looking to trade the retest or they're looking to trade the breakout, right? There is so much liquidity that comes into the market from here. And then where do all the stop losses go as well? All the stop losses go down here. All the stop losses go down here. So when price comes back into our point of interest, once we get into step 4, which is our confirmation, essentially price is then bound to target these lows. And the thing is when there's already a bunch of engineered stop losses at all of these lows, what happens is every time price triggers an area of where those cluster of stop losses are, those stop losses trigger into the market as additional sell positions, which further does what? Escalates price. It further pushes price lower, because every time a buyer steps into the market and they put a stop loss in place, all that stop loss is a sell order. It's essentially a sell order that says, sell me out of this position when price hits this level and I'll take my loss. But it still triggers in the market as a sell. So when price hits those cluster of stop losses, well, a bunch of sells are getting triggered into the market, which does what? Takes price lower, which is exactly what smart money want. So that is what we're looking for. Step number 3 is an area of institutional manipulation. What we need to see is a liquidity pool form just before our point of interest to make it high probability. So after we get that liquidity pool build up, then we want to wait for a manipulation of that liquidity pool into our area of interest. And then we're going to wait for step number 4, which we're going to dive into right now. Okay, so now we're going to be diving into step number 4, which is institutional confirmation, right? You've got everything. Step number 1, you know where the market's going. We are clearly bearish, right? Okay, putting in lower lows. We know our current trading range is from high to the low. So we know that we're trading inside of this trading range. We already know that we want to sell when price gets into the premium of this price leg. We already know where our institutional area of interest is, right? We've already had our range, our manipulation, and our initiation below the previous low. We've already seen the institutional footprint step into the market. We've already seen the internal liquidation build. This internal liquidity pool has been built. And now institutional confirmation. You see, as price comes back up, right? This is where multi-time frame analysis comes in, because you see this dotted line here that does this. This is going to be representing the 1 minute time frame, whilst these full lines are going to represent the 15-minute time frame. So what you see is we have a bearish 15-minute time frame, which is our time frame for our directional bias, our bearish 15-minute time frame. And then as price comes back up from lower low to lower high, as price comes back up to put in a lower high, what happens? On the 1 minute time frame, you will be looking at that data and it will be bullish. It will be putting in a series of lows, highs, higher low, higher high, higher low, higher high, range for our liquidity pool, low, higher high, higher low, higher high, inside of our confirmation area. We only, and I mean only, act on our initiative when we get our confirmation. And our confirmation is this. Our confirmation is when price has, number 1, run the liquidity. We've run the internal liquidity, done. We're inside of our point of interest, done. Once we get a lower time frame, so 1 minute time frame, pullback, break of structure, and a market structure shift or a change of character, depending on the quality of the setup. Once we get the break of structure and the market structure shift, that is when we act, because what that tells us is, okay, buyers are controlling the market. Buyers are determining the trend. Buyers are in control. We're getting to our institutional area that is protected. And then what happens? Aggressive selling steps into the market, takes over. And the low that buyers were just previously protecting has now been shifted. That's a market structure shift. Therefore, what is expected? Expected lower prices. It's quite simple. Essentially, the market only moves off supply and demand. If there's more supply than there is demand, then price will drop lower to collect the demand. If there's more demand than there is supply, then price will trade higher to collect the supply. It's that simple. So with that being said, we've just shown that we've had bullish price action shift to bearish price action on a lower time frame. We're already bearish, so we're already expecting lower prices. We're just waiting for this lower time frame confirmation. Once you get that, again, it's going to be the same exact thing, right? All we're doing is understanding market structure, right? We had higher high, lower low. Now we're bearish. We're expecting lower prices. We're going to look at that same level, right? It's going to be that same area where price ranges and then sells off aggressively. That's going to be our point of interest, right? Our institutional area of interest. It's the exact same thing. Then you're going to map out that level, and then you're going to take your trade. You're going to take your short position, open in here. You're going to put your stop loss just above the high, and then you're going to take out the next swing low, or at least 5 risk to reward. That's our entry confirmation. So just to really quickly recap, and then I'll go and show you this in a live example. Step 1, we're always looking for trend in market. We identify the external swing points of structure, and if they're making lower lows, then it's bearish. If they make higher highs, then it's bullish. Very simple stuff. The reality is that it won't look so simple. It won't just be high, low, high, low. They'll have a lot of these internal structure points in place, but if you abide by the principles of understanding swing high to swing low, everything else is internal, you'll be fine. Step number 2, identify an area of range before an aggressive sell-off or an aggressive buy in a bullish scenario. When you get the aggressive sell-off, that is your institutional intention. You want to identify the range, because this is the transactional range. That is going to be your point of interest. Step number 4, we want to wait for a buildup of internal liquidity on our way back up to that point of interest. And then we want to wait for it to be manipulated and trade into our point of interest. And the final step is our lower time frame confirmation. When we get in here, we don't just want to enter. We want to make sure that our bias is correct. And we do that by identifying lower time frame structure shifts back in alignment with the 15-minute. And then finally, step number 5 is getting into the trade and then managing the position. When do you go break even? When do you take off partials? When do you move your stop loss? All of these types of things. That's what I'll show you in the next example when we go to the live chart right now. Let's go. Okay, and finally, step number 5, I'm going to tie everything together to show you exactly what we just learned in theory, take it over to the live markets and show you a practical demonstration step by step. But just before we break down this incredible trade, this is the exact bias that I gave my inner circle members just a couple of hours prior on our live session. I was waiting for this exact setup step by step, and a bunch of members took the exact trade. If you want to be having insider access to these live real-time insights that I give to my members to understand price action, if you want a proven profitable trading strategy or 2 that are backed by years of data with trading plans, if you want psychology programs, multiple live sessions, access to me and other mentors, multiple 6-figure traders, then you can essentially apply to work with me down below. There's a quick form. You can fill it out. There's only a few spaces. We don't accept everyone, but it's worth a shot. And if you know, and who knows, maybe we can work together. So let's go ahead and dive into this trade breakdown. So this is the exact trade. The trade was taken on the 18th of September. And as of recording this, it is the 20th of September. So 2 days later. And yeah, let's dive in to a step-by-step. So what I'll do is I'll bring us back before the trade occurs as to why I was even looking at this setup, because in this green box right here, this represents the London session, right? 2 a.m. to 5 a.m. EST. That's my London session window. That's the session that I trade every single day. That's the session that I trade with the members, giving my, kind of step-by-step playbook, what I'm looking for. So when the market opened, I had my live session with the members, and this is the exact breakdown I gave them, which I'm about to give to you. So it's very important to understand that this blue box here, this blue box represents Asia session. Now, Asia is notoriously known to be a pocket of liquidity. So when we were talking about step number 3, that internal range liquidity, I always use Asia. We can historically look back and you can see for yourself, right? Blue box, manipulation lower, manipulation higher. Blue box, manipulation lower, manipulation higher, right? We can go back again. Not this day, but blue box, manipulation lower, manipulation higher, right? We can do it over and over again. Manipulation higher, manipulation lower. Manipulation higher, manipulation lower. So I really, really emphasize my understanding of Asia. Now, you can't just trade Asia without any context. There's a lot more to understand to it. But yeah, I just need you to know that so that when I break down the trade, it makes a lot more sense. So what was step number one? Tell me. Step number one was identify institutional bias. We already had a higher time frame bearish bias in mind, but even our 15-minute time frame had to align. So it's very simple. You can see that we had an external structure point here, and that structure point was broken. So at that point, we were bullish, right? We had a break of structure. We were indeed bullish at that moment in time. Well, the lowest point that price pulled back from this level was here before we broke structure. So that was our swing low. That was our swing high. If price wanted to continue trading higher, it would have come into this level and traded higher. It clearly shown us that it doesn't want to do that. It broke the swing low down here, give us a change of character, right? A shift in structure. So now we're no longer expecting higher prices, we're expecting lower prices. So what happens? You can see then we have the high, price breaks, there's no pullback here, there's no pullback here, there's no pullback here, right? I have a specific rule for my pullback criteria so that I make sure that I'm never wrong on market structure. Swing high up in here and swing low down here. That is my structural range. I'm swing high to swing low. So when I come into London, the only thing I'm interested in is selling the market. That's it, period. So step number one is already confirmed. I'm looking for sells because price is bearish. It's very simple. That's our swing high. That right there is our swing low. I'm expecting that this low is going to be taken out. And before that, I will be expecting what? Phase 2 and phase 3 of the setup. So step number 2, identify an area of institutional interest. Well, what happens before we break structure, right? This is the aggressive move. That right there is the momentum. That's where you see all of the orders initiate. What do we get just before that? We get our range, our buy, and our sell. That right there is our cluster of orders. That's our institutional area of interest. So what I want to do is I want to map out this wick right here. And this wick also consequently liquidates the high. So what happens in this wick? Does anybody know? If I drop down to a lower time frame from a wick, you'll see this. You'll see on a lower time frame, you'll see a buy and then an aggressive sell like this. In fact, we can even go and take a look at it. Let's go to the 5-minute time frame and take a look at what that looks like, right? Again, on the 5-minute time frame, it's another wick. Still a very aggressive buy, manipulating highs and then lower. What happens if we look at this on a 1-minute time frame, right? If we pull across and look at this on a 1-minute time frame, what does it look like? You can see it's a very aggressive buy above liquidity and then the aggressive sell to continue the move. So that's our point of interest. It's quite simple then. That's our range and initiation, just as we were looking at previously. So we have our area of interest, right? It also has a fair value gap within it. We have that area of interest. Okay, so step 1 and step 2 are both done. We have our bearish bias. We're expecting lower prices. We have our area in which we're expecting those lower prices from. Step number 3 is identifying our internal range liquidity. That for me, again, is always Asia. It can be equal highs, equal lows if Asia's already been manipulated. But in this scenario, it is most definitely Asia, right? My highest probability setups are where Asia is just sat before my point of interest. So we have liquidity in here. There's our liquidity. And then what am I waiting for? And this was my bias. I was waiting for price to breach that liquidity, come into here, give a market structure shift like this, which is my confirmation, step number 4, and then get into the market in here, and then take my profits at this low and at 5R, right? Which is what I'll show you in just a moment. So we play price, we're waiting at this point, we're waiting at this point. Okay, so now Asia has been manipulated. So now my interest is peaked. My curiosity is peaked. What's going to happen next? Price gives a little bit of rejection, another rejection, still nothing for me at this point, still nothing. I need to wait for this. Now here's what happens to a lot of traders, as I previously told you. What happens is when they see these rejections coming in, especially in a lower time frame, they are eager to be selling early, right? There's a bunch of different ideas here. Number 1, there are the people that are breaking out, right? So the breakout traders, they're buying this level. And where are they putting their stop losses? If they're buying the breakout here, they're probably putting their stop losses down here and they're probably targeting up here. So we know that there's a bunch of stop losses at this low in here. Okay, cool. What about everybody who's selling off, right? Selling the resistance, selling the fake out or the resistance or the rejection after a high, right? What happens for them? They're selling in here. Where are their stop losses going? Their stop losses are going above the high. Their take profit's probably going somewhere within inside the trading range. So it's all about building context to understand where everybody else's stop losses are, so we can understand where all the liquidity is, because we understand that the majority of the time price will run toward that liquidity and then run away from that liquidity. So we want to make sure we're not caught in those moves. We want to make sure we're getting in after those moves. So again, I'm waiting. There's the real manipulation of price. The moment that price touches this gray box, I'm into my lower time frame. So now I'm on the 50-minute. Now I'm dropping down to the 1-minute time frame, and I'm just following the, structural understanding, right? I'm following these swing points. So what do we see? So we're seeing a breakup of the highs. So we had a low, a bullish high, we had a pullback, we had a bullish high again. So again, I'm waiting for this low to be taken out. If this low gets taken out, that's my confirmation for lower prices. So price comes to that level, respects that level, and then breaks above that level. Okay, no problem. So now we have what? Now we have a new low. Now, if this low gets taken out, that's my confirmation. And this is again why we have the confirmation. We're not trying to get in early, and we're trying to get better risk to reward. Okay, so what happened? We broke the highs. We're waiting for this low again now. Let's see. Okay. Still no. Okay, so now what have we done? We've broke again above another high. So we have low, high, low, high. So now we need to see a break of this low. Again, see how I'm patiently waiting for the confirmation? Because what happens is buyers are controlling the market right now. But the moment the low that is currently in control of the market gets broken, well, inevitably so, that is the shift of power. What you also notice, again, before we do get a shift from one of these areas in the gray box, you'll start to see slower price action, because what's happening is we are now currently experiencing a battle between buyers and sellers, right? Essentially, when price starts ranging and not just moving in these prices, when it starts doing like this, as I've already explained, we are now entering into a battle between supply and demand, because there are lots of orders transacting at this one level. And then you can see the aggressive sellers come out on top of the market, and we break the low, right? That is our market structure shift. Okay, so where are we looking for? It's the same concept that we use on every other time frame. Our principles remain the same. What we're identifying here is what? The range, right? What happens before the sell-off is the exact same thing. We're looking at the range and then the sell. It's the same thing that we're looking for here. This area right here is a range and then a sell. So our principles remain the same. They're just understanding price action. So that's our area. So what I want to do is I want to take my entry in here, and then I want to actually protect my stop loss the best I possibly can. This is part of trade management. I don't care about just trying to optimize the risk to reward. I want to make sure that I stay in this trade and remain safe. I take my trade, I cover the stop, a little bit of room for additional manipulation or spread or whatever. And then my first target and what I'm looking for is 5 risk to reward. My first take profit is always 5R, right? I want 5 times my risk. That's what makes this profit. That's what makes this strategy so profitable. Every time I win a minimum 5 times what I'm risking to lose. So even if I take 3 trades and I lose 2 of those trades and I win 1, then at the minimum I lost 2 and I gained 5. So I gained net 3R, right? 3 times my risk. Let's say I risk $1,000 per trade. Then if I lose 2 trades, I lose $2,000. And I win 1 trade, I made a minimum $5,000. Therefore, it's extremely profitable in the long run. So again, what are we looking for? 15-minute time frame. I'm looking for a continuation of structure. That's obvious. So I'm expecting this swing low down here to be taken out. So that's my overall target. But I always set a 5 risk to reward partial profit, because a lot of times you may be right in your idea of getting into the price. Price may come in and go lower and then trade higher. That can absolutely happen. There's many other scenarios like that as well, which I won't go into too much detail in this video. But yeah, that is target number 1. And then down here is target number 2. Now, I'm going to be fully transparent with this trade. I'm not going to try to manipulate the data or make it seem better than it was. I'm going to be completely honest with you because I believe in transparency. So what happens? We get tagged into the trade. Price respects our level. We manipulate this low right here. So that's not a reason to go to break even. And then at this point now, we already moved our stops to break even. So right now, our stops are at break even. It's a risk-free trade. I cannot lose money on this trade. And so now I want to see price trade to 5 risk to reward in which I'll take 50% of my overall position off. 50% comes off at this 5R level, right? So we're just waiting for that level. You can see that this confirmation showing us that we're ready to go, but it's not about this time frame. It's about where we are on the higher time frame, right? It's the higher time frame that's caused us to be trading in this range. So again, what do we see? We see a range, we see a manipulation, and then we see the sell-off, right? And there is the move into our 5R. At this point, 50% of my position is off the table. Now we're heading into New York session as well, which is again very important to understand timing and how price reacts to timing. So we are at 50% of the position comes off. I'm at break even, and now the rest of my position I'm holding down to this low. So I'll take another basically 3.75 times my risk if we get to this level. But in this specific trade, this is what happened, and I'll be totally honest. Price came back up. I got break even. So the rest of my position was closed at no win, no loss. But then price decided to do this, right? Price decided to come back to break even, stop me out for no win, no loss. But I did make money on this move in here. I didn't make any money or lose any money here, and then price runs to my full take profit. So I missed out just narrowly on an extra 3.75 times my risk. And so obviously if you're trading, if you're risking a few $1,000s, that's a fair amount of money. But that's the game of trading, that's transparency, and that's the reality of trading. If you like this video, subscribe. Let me know down below what video you want to see next.